Charles, welcome. So part of the argument here seems to be, yeah, you're growing, but you're not growing nearly as quickly as the hyperscalers. And, you know, if we get into a bad economic environment, if demand comes down, the hyperscalers are going to keep using their own systems, but maybe not those of outside data center providers. Why is that wrong?
Well, first of all, thanks for having me. I mean, I think that really the premise that the cloud is really just these large-scale compute node facilities from a handful of hyperscale providers is just, you know, not accurate. It represents an underdeveloped understanding of really how the cloud actually works, how it's architected, and the role that and how enterprises are really re-architecting their IT for digital. And so I think that you know, right now we play a very critical role in helping them companies move to hybrid and multi-cloud, and I think our business is showing that.
Well, I guess the question, though, is valuation. I mean, I certainly do understand, and I think Chanos would say that he understands that the cloud isn't just about the public cloud, that there is hybrid, that it's distributed across both their owned and operated data centers and others. But when you look at their rate of growth and you look at the amount of capital investment that it's taking you to do what you do, the question is there enough profit in the model for these valuations to make sense?
Well, absolutely. I mean, I think one key thing is the segmentation of the data center market between, you know, the set of providers that are working to provide these hyperscale data centers, these large-scale, dedicated, committed centers, versus those that are building this sort of intercloud, interstitial data center that are really the digital edge, points of aggregation in the digital ecosystem that really allow the cloud to work effectively and allow the customers to extract the value from their digital transformation. And our business is growing very nicely on that and we think we have the balance sheet to drive that and the returns. And if you look at our returns, they're exceptional in terms of, you know, how we're delivering AFFO per share growth.
Very capital intensive this business is, though, and interest rates are rising. So when you talk about your balance sheets and you wonder what demand is going to be like, how much are you going to have to outlay to continue building? And is that going to get more expensive for you over the next couple of years?
Sure. I mean, at some level, I think that will inevitably. We're an investment grade rated company, so we can raise debt under very attractive terms. Definitely, the cost of debt is going up a bit with interest rates, but I think that our ability to raise a combination of equity and debt to fuel the business, and our ability to price services in accordance with the value delivered to our customers, and therefore maintain consistent returns, even in an environment where that capital might be slightly more expensive, I think is extremely robust.
Well, if there's an advantage to having a very prominent short seller on you, it's going to bring a lot more attention to your model and to your growth. Charles, thank you.